How insane is it that we have to wait for some organization to tell us what inflation is? Inflation should be easily observable, and it is. We live in this world. We buy things in this world. If Powell was really serious about killing inflation, the way to do that would be to raise rates to 10%.
You have to work both sides of those things. You can't just prepare for Armageddon, right? You need to make your clients money. All right, everyone, welcome to another episode of Investing Counterpoint. Thank you so much for joining. Daniel, how are you? Exciting times.
Doesn't stop. It just does not stop. Everything we talked about, it's like you used to make a prediction and you wait for a year or two, or in my case, 10 years. But now you make a prediction and it comes true in a matter of weeks. And many different kind of predictions come true because so many different things are happening. To those that are new to the show, Investing Counterpoint is a show for financial advisors. Here we teach you how to measure risk, how to understand risk, how to explain risk, and win clients and keep clients by becoming a top risk advisor. So in the last couple of shows we talked about, I'd say over the last 2 months, we talked about interest rates, right? We talked about the Fed increasing rates as everybody else did. We showed some really interesting scenarios about the Fed that's going to keep hiking, and it was a big bull run in the middle, but we try to analyze it from different standpoints. You see, we're trying to convey to you that risk manager doesn't have to predict things. Risk manager just has to have different scenarios line up, stress test them, and have a portfolio that doesn't have catastrophic losses, or if it does, it loses in those types of assets where you feel very confident in the scenarios that you prepare for. For example, if you're building a very aggressive portfolio and you feel like there's some really high growth stock that's going to give you high alpha, you're going to make a bet. If things go south, you're going to lose a lot of money, but it's because you made a bet, you made a conscious bet. That is not necessarily a risk management failure, right? Or not at all. The risk management failure is when you make a loss and you're like, I didn't really care about this investment to begin with. I didn't think it was there for some other reason. It wasn't a big bet. So the risk that you spend as a cost, we want to make sure you spend it wisely. And that's the standpoint that we kind of, the viewpoint we choose and we talk about. So what happened the last couple of days, we've seen inflation come in quite high. And it shocked a lot of people. Most everybody thought that inflation was moderating. I'll go right out and say this, Jan. This is very, very strange. You know what I find extremely strange? I think in this age of mass media, we've all become a lot dumber. For quite a while, I was with everybody. I was like, what's the inflation print going to be? And then the inflation print was surprising. And then there's all these events. And then I sat down, I paused, I took a step back, and I thought about this. How insane is it that we have to wait for some organization to tell us what inflation is? Inflation should be easily observable, and it is. We live in this world. We buy things in this world. So it is just the testament to the insanity of these times that inflation can come in and shock everybody in the country.
Right.
It's almost like they tell you the weather for today and you are shocked. Well, you live in it. You observe it. So I think that right there, when you talk to your clients, you have to explain to them there's so many irrational things happening right now that you are the advisor, hopefully, that's trying to bring some rationality. But your rationality cannot defeat irrationality. It can just manage it. You can protect from the worst outcomes. But how crazy is it that somebody has to tell us what inflation is when we experience it every day?
It is kind of crazy, but when you think about it, the most observable parts of inflation are really something like gas prices, because you go to the pump and if you have a car like mine, which has a huge tank and doesn't do well on gas, you end up spending, instead of $75, you end up spending $125. And that's a big in your face print, right? But less observable are some of the things like, the owner equivalent rents. Less observable are the food prices even. I mean, yeah, you might see that your bill's going up a little bit, but you don't go to the supermarket and buy the same exact things every month. So I think when we see inflation like this, 9%, 8%, yeah, that should be more observable. But when you see it around 3 or 4%, especially, I mean, it really depends on the economic situation of people too. I think lower income people will feel it much more acutely because their dollars and cents are managed, to the penny. Whereas high income people, wealthy people, are a lot more inflation, I think, resistant. If I have to spend, $4.50 versus $4 in eggs, that's over a 10% increase, but I'm not going to notice that as a wealthy person. So I think that, I think that,
there's gotta be, I mean, if you have these high paid people waiting for somebody to announce inflation results, how hard it would be to have them sitting there calculating and having transparent numbers that everybody can agree on. That's what I don't really understand. I don't think I will ever understand it. I've been in this financial markets for quite a while, and I'm just not smart enough to.
Well, here's what else is interesting, and I could be wrong about this, but inflation from July to August didn't move all that much, right? I mean, we saw gas prices come down, so maybe that's why people expected it to move. But we're really looking at year over year.
Yeah, it was the energy, for sure.
Yeah, and so we're looking at year over year, and so in a sense, it's you're living through it and thinking about, I need that print to know what the impact on the market is going to be. I mean, I think something like today's FedEx report is a lot more impactful to the market about inflation because, this is not just pricing, this is demand. With FedEx saying that they're seeing, that they're going to miss their revenue target for this year by something like $500 million, which I didn't check to see what percentage of their revenue target that is, because that obviously really matters. 500 million on a billion is a big number, but 500 million on 100 billion is, not a big number.
No, it was a big miss, especially vis-a-vis the expectations. I mean,
it's a big miss because they're down something like 25%, right? I mean, they're down a lot today. I don't know exactly what the number is, but it's a big miss, I guess. Yeah, that would indicate that it's a big miss. And that's a better indicator about not just inflation, but how much inflation is really hurting consumers, because I think that's really the point. I think that's what people need to be reacting to, because if the consumer is slowing down, if the FedEx is shipping less packages, especially they said in Europe and Asia, and we've had a couple episodes where we've talked about Europe and Asia. So especially in Europe and Asia, that's something that might not be as acutely observable to the U.S. Consumer investor that's waiting for that inflation print. So I would argue that could be a much more important data point in this.
Yes, but Fed explicitly said we're going to be data driven, and this data turned out to be really opaque. The big component what of it was healthcare that continued to increase. Pharmaceutical companies. I don't know. Years ago, they were a huge part of I think they just now own the world from the last 5 years. I think they're just like, we just own it. This globe, just, wrap it up and that's it. We need another planet. So, but yeah, I think the absurdity just strikes me, this time. I've been watching this, trying to make sense, but this absurdity shouldn't make you give up. I mean, your clients still need you. Stay sane. It's just you have to understand that there's some irrationality out there, and then I think there's irrationality on that's not like just the crowd buying or crowd selling or the bubbles, but throughout the financial system. But inflation is not dropping, and I think it was even for now. Like I said in the last or the next to last episode, that you've never had a record of inflation being defeated until the real rate was positive. So. If Powell was really serious about killing inflation, the way to do that would be to raise rates to 10%. He would kill it in a few months. Now, it wouldn't bring back energy supplies, but it would cause a severe recession. But it would be over. It would be over. But this kind of incremental, now they're expecting 1% increase, right? That's the expectation possibly.
Which I think I laughed at last time we talked about it. I said, no way.
It seemed completely.
I needed that print to get there. I needed that inflation print to get
exactly.
there.
That's the strange thing, right? And you do this, and I do this for a living. So, but I think this incremental stuff is just going to kill the economy slow, which is much worse actually, because you don't fight inflation slowly. It's just going to keep getting out of hand. Like Europe is another example. Our last episode had to Europe about European interest rates. I mean, you've seen that on one hand, they're trying to fight inflation again with these 3/4 basis point moves. But on the other hand, like UK announced like 110 billion package. Europe, continental Europe announced a huge subsidies just so people don't freeze. And this is where we are. It's like you're fighting inflation with interest rate increases. First of all, inflation is at least partly non-monetary. It's supply side inflation that you cannot, I mean, you can raise interest rates to 100%. It's not going to create more oil and gas in the world. That's one part of it. But the other part of it, as you're raising the rates incrementally, not enough to kill the inflation, but actually enough to stoke the inflation and kill the economy. At the same time, you're creating these subsidy packages, which are pretty inevitable. I'm happy that people are not going to freeze to death, but it's like it seems like almost like a controlled demolition to me. It's hard for me to fathom that these people don't know what they're doing. I know many people believe they don't, but I think they do. I think they realize that there's going to be a lot of pain. And you look at statements by Jerome Powell, by Isabel Schnabel from ECB, they all say there's major pain, there's shocks ahead, and that's what they're trying to prepare you for. And that's why our show, I think, is relevant, is that we're trying to make sense of this, because they're just saying words like the shocks ahead. But what are these shocks going to mean to people's portfolios, Jan? And you showed me some really interesting charts. You look at this data. What do you think? What do you think it's going to do to like a traditional 60-40 portfolio, which normally is a pretty solid allocation?
Well, I mean, I think there's been a lot of movement away from that 60-40, and we can debate whether it's a solid allocation. We can debate, whether the 60-40 is dead, so to speak. I kind of think that using words like dead is not necessarily appropriate. So if you let me share the screen here, I'll do that. But while you're doing that, one thing that I wanted to bring up is one thing that Larry Summers said, and you can say what you want about Larry Summers if he's I know people have very different opinions about him. But one thing he said is that there's no record of the Fed hiking interest rates too fast to kill inflation, only too slow. He said, even in the Volcker scenario, and again, this is his words, I'm not going back to prove this or validate it. The Fed eased off for a time before they really started to raise rates in earnest. And he believes that ease off is really what let inflation get out of control, so that they had to do that. But he said that, according to him, there's no record of the Fed raising rates too fast to kill inflation. Now, how many times the Fed has had to raise rates that rapidly to kill inflation, I don't know. But he's a pretty smart guy. But and that's what he said. But I read that this morning.
That's the Volcker era that everybody's really looking back on. But there was not nearly as much debt. So It was a very different financial system.
Yes. So Daniel, this is
you still had Glass-Steagall. You didn't have a lot of the things that got out of control that have really transformed the financial markets into a casino.
Yeah. Yep. No, that's absolutely correct. And we saw that no better example of that than 2008. But without the inflation component. But what we wanted to talk about here, we were talking a little bit about 60-40. But I thought that the conversation about correlation and about how markets relate to each other is interesting, because we always talk about, and I was at this RPAG conference, which was the last update that we did. It was just me alone at the RPAG conference. And there was a lot of talk about risk, like I said, and there was a lot of talk about diversification and allocations to your portfolio. There was a whole session called the asset allocation problem. And, I've been thinking about this one since we did our, I think the one before the European update, where we were both a little, we've been talking about how the markets were falling and how to prepare a client portfolio right at the time that the market started rallying. And like you said, Daniel, it's your job as a risk manager isn't to be right about the direction of the market. It's to understand what's going to happen when the market does do something, but also,
or especially the timing, especially not the timing.
Yeah, especially not the timing. But you do have to be aware of what your portfolios do on the upside too, so that you can't be caught off guard by the increase as well. So, you have to work both sides of those things. You can't just prepare for Armageddon, right? You need to make your clients money. And when the market is maybe whipsawing is the wrong word, but it's taking pretty drastic turns, positively and negatively, which is a normal cycle in the bear market. We talked about this happens in 2008. I think I said, this is something that happens in 2008 or happened in 2008, where you had, head fakes. But what I wanted to talk about here was the correlation between markets. And these are pretty broad markets. I'm not going in depth into any particular, sectors or anything like that. But this top graphic here is going to show you the correlation of different equity markets to the S&P, okay? And it's done in 3-year weekly tranches. So this is a 3 years ending 9/22. This is a 3 years ending 9/19, and et cetera. So there's no overlap here. And what we can see, and the raw data is here on the side, but what we can see is that equity markets are kind of always pretty highly correlated, right? So the small cap is always around 0.9. It did dip down a little bit, but the small cap is always very highly correlated to the S&P, as is the stocks. One thing that we can see here is that the Nikkei right now is actually exhibiting a lot more correlation, and we also see a bit of compression in that correlation. We saw it here in 2000, the period that engulfed 2008. But we're seeing it again where all of these correlations, maybe like never before because of the Nikkei, have really gone within 20 0.2.
That's a very interesting observation. I would not have known that about Nikkei actually, and I don't have a ready explanation as to what changed, because Bank of Japan is still behind on raising
so
rates.
far.
Seems
so
like
far behind.
they're continuing their detachment from the real world experiment. But yeah, go ahead.
Well, maybe that's why it's still there, because people don't think that's a good idea either. This detachment from the real world experiment they think is worse than the raising of rates experiment. One thing I do want to say about this too, the one reason why I did weekly, so and we use weekly in our riskostat and PCT risk models too. Weekly gets rid of not just noise daily, because daily relations can be useful, but we're using weekly because you want to make sure that the markets are absorbing the information at the same time. So if you think about the Nikkei and the S&P, they're not open at the same time. So the Nikkei will close. The Nikkei will close. Some news will be released either U.S. morning, Nikkei afternoon, evening, and the S&P will react to that. The U.S. markets will react to that, as well as Europe, but I'm skipping Europe for right now. The S&P would react to that, and then the U.S. will release some news after S&P close, and the Nikkei will react to that completely in isolation. The European indexes and the U.S. indexes have some time together, and sometimes you can see that the European indexes will do something, and then the S&P will open, and that will pull the European indexes one direction or the other, depending on what the news is and the reaction from the U.S. is. So by doing it weekly, we kind of get that market cycle over the week. So it's a little bit more of a full story or a full picture of the reaction. And remember, we're only talking about correlation, not returns here. So when we talk about correlations, if I see a low correlation, it does mean that there's a diversification, but it doesn't mean that because one is up and the other one's going to be down or anything like that. We're just talking about the relationship of these assets. And so that's why I thought this was very interesting, but other than it being compressed and the Nikkei being out of normal, there's really nothing that abnormal about the correlation picture that we see here across these broad indexes, right? So diversification across country, well, specific countries will be different, but across, region, like the Euro region, emerging markets, Japan, it's not going to be that, drastically different than it has been for the past set a bit of time, except for the correlation profile of the Nikkei. If we come down to this next one, this one we're looking at a few different indexes that I wanted to check out, which is essentially these are just Bloomberg Treasury and corporate indexes, along with a high yield index and a REIT index. All right, so we're looking at those relations here over the same time periods.
For bonds, these are returns or yields?
These are returns. These are returns. So we're looking at, so basically the index will have a return component to it. So I'm not looking at the yield component to it. Right. So what we're seeing is, so if I look at just this treasury index becoming, from negative correlation in 2013 up to, almost zero correlation now for the treasury index. And this is all different kinds of treasuries. We're seeing that there's no relationship between the S&P and treasury, whereas we've had in the past, the crisis period, I mean, this is a pretty large negative. That's 0.4 negative. 2013 period, we saw negative 0.6 almost. So and that's kind of what you want. You want them going in the opposite direction. That's what gives you that diversification that the 60-40 portfolio is supposed to give you. I mean, again, I'm talking about directionality, not returns, but that's the idea.
But it's fair. I mean, you're not implying any causation, but in a portfolio, it should provide diversification. Yeah, according to
exactly. And now what we're saying, based on this broad index, we're saying that there's no diversification. It's not the same direction, but it's zero.
It's disappearing.
Exactly. And we're going to see something in a second that I think will be even more surprising. And then corporates. I mean, this is a real shocker. I've always thought of high yield as an equity proxy, right? I mean, because the spreads on the high yield really act more like equity than they do fixed income in a way, because that spread impacts the price.
For sure, yeah. I mean, because it's even if you look at the debt structure, it's lowest in a debt structure, closest to equity, but also because essentially a percentage that you pay to risk investing in companies that can lose everything.
Exactly. And so we've seen even this is higher than it's been. I mean, this is up at about over 0.8 along with REITs. Again, these are both highs. It doesn't look terrible on this graphic, but these are both high points here. But the corporates are the real surprise here. Corporates have been around zero and negative as well. Negative 0.25 and
this is basically all investment grade bonds, non-high yield.
That's right, exactly. Yes. Very important. All investment grade bonds here, and that's gone up to 0.6. So even the investment grade bonds are acting more like equity here. So you're losing that diversification aspect, which is zero. You're basically zero to negative, not to the level of treasury, but still a diversifier in your portfolio, which has gone away to an extent over the last 3 years. And this isn't just zero anymore. Now we're talking about we're up near 0.55 here. So much different than these other data points previously. Now I should say something about this period. We have had COVID and this market recession. But the point is that it is acting. The portfolios are acting, or the assets are acting differently now than they were before that, regardless of what the cause is. And finally, maybe the most interesting one.
Yeah.
This one's really interesting. And I threw in a commodity index here, and you can see that the commodity index is really kind of maintaining its correlation structure. Where 2007 period was really more of an outlier, but you're kind of 0.4, 0.3, 5, 0.3, and now you're back at 0.4. But if we look at the U.S. bond ag, now this is all kind of all bonds in the U.S., the aggregate bonds. So we're including corporates in there. I don't believe that there's any high yield, but there's munis, there's all kinds, treasuries, all kinds of things in there. And then we have the global bond too. I mean, if you look at the global bond aggregate, I mean, look at where this has come from, zero and negative up to, again, positive 0.4. I mean, so we're really seeing a much reduced correlation profile amongst these assets.
Much increased correlation. I mean, much reduced diversification, actually.
Yeah, much. Yeah,
and I know it's just the way you phrase. I mean, I know what you mean. Yeah, but it's diversification is vanishing, folks. I mean, that's what we're seeing is over the last couple of years, and now we're getting a lot less diversification. I wonder if you do like a 1 year rolling, it probably shows even more of that trend.
Yeah, I could do that. What I didn't want to
do it next time. I think this is interesting enough to where we could continue this because this is fascinating to me. I haven't, I've seen some studies on this lately, but studies are dense and you don't always have the time to go through and read them. But this is so clear that essentially, can you show that again? You showed the US aggregate, but there's also a global aggregate in there. So typically you diversify, by asset class is one dimension, but globally diversification should happen. Here it's not showing any of it. Global bond aggregate is doing the same thing. In fact, it's more so. The orange line increases higher on the lower chart, right? The global bond aggregate goes all the way. What's the last value that you have?
The last value here is about 0.4.
That's a huge, that's a really massive correlation for such types of asset classes. So you would see that if we're seeing the direction that the equities are down and this correlation holds, your asset allocation will be under pressure. And we're not scaremongering. We don't mean to scare you. It's just a fact that you need to re-examine the behavior of your asset allocation strategies in this environment. I can show some. I prepared a stress test that we can take a look at. Let's see.
One thing that while you're doing that, Daniel, too, I want to talk about is we've seen it this year. I mean, year to date, if you're invested in a simple 60-40 portfolio, that is the MSCI World and the global aggregate, you're down about 18%. And each of those, the global equity markets are down, 18+%, and the aggregate is down 17% or so. In the U.S. market's a little bit of a different picture where you have the S&P down 16-17%. I forget what it is exactly today, and then the aggregate U.S. aggregate portfolio is down 12%. So you can see that these are not, these are, directionally they've gone the same direction. I mean, like we've talked about, correlation is not causation.
Not
but these two
look like
things
a
are
temporary thing, actually.
Yeah.
So I'm using portfolio crash testing, which is our application, RiXtrema, our flagship risk application. You can, if you're interested, you can request a demo below the video or go to RiXtrema.com and request a demo. But you don't have to be a client to consume this information. So what I've created here is called a custom stress test, and that's what portfolio crash testing is known for. You don't just use the stress test that we pre-design, you can design your own. And so what I did is I took two factors that I want to shock. Is S&P 500, that's pretty obvious, but I also took international debt fund aggregate. This is a RiXtrema aggregate. This is an aggregate we create from international debt funds. So I took it as a proxy for your global bond aggregate. And so far, what I have is only a shock of minus 35% to S&P 500. So I'm saying I have this moderate risk portfolio that we've used in previous videos. By the way, if you like this video, I highly encourage you to watch previous videos. They're not outdated. This is not a news show. Every show is something, gives you something you should be doing regularly, permanently with your clients. So every show will give you some tips. But this is a risk moderate portfolio. It's got quite a few different kinds of assets. I swapped out, I think, one of the value funds and actually put in some agriculture, Invesco Agriculture Fund, just for good measure to see how it does. And I've shocked S&P 35%. What you're seeing on the right is, first of all, there's a loss of 15.7% or so, 1566. It's $100 portfolio, so dollars and percent are the same here. But these two charts, green and red, they show me which parts of the portfolio are positive and negative contributors. So, for example, I see that Fidelity Spartan 500 is the biggest loser. It contributes 5% to my loss, which is completely not surprising because we're shocking S&P 500. But like an Invesco balanced fund loses 2.5% for me. Now, I have much bigger weight in it, 71. I have a bigger weight in 17%. But I do have some positive contributors, and that's what we're calling diversification, right? I have the government bond index. I have the core bond index and kind of a U.S. bond aggregate, right? Which is similar to the U.S. aggregate that you had. They cushioned the blow to some degree. Not a lot here. Not a lot. Even though I do have the core bond is 12% government bond. So you based on the model now, just in the sense that if you have a stock drop per se, you have little protection, right? Only 50 basis points of protection comes from our kind of 60-40 allocation portfolio. So the bond portion of the 60-40, or is it not 60-40, right? But it's close to that.
Right.
The bond portion does not give us good protection. But what if I assume that global bonds drop? Because your chart would suggest that the global bond index will drop. In this case, it's a kind of special index. We can see that volatility is 1%. And usually you shock between 2 to 3 times volatility because it's standard deviation. That's a little rule of thumb. So I'm going to shock it, let's say 3%, right? That's going to be almost a 3 standard deviation move. That's a big shock. So now we're having stocks are down and global bonds are down, which is what your graph is suggesting, is that if we enter into this environment and the central banks continue to, with their slow destruction, that's what we're going to see. Look what happened. We have no green. The only green barely is the short-term bond. The short-term bond, simply because, the short-term rates are also going to be increasing for sure, but the duration is low. And so there might be a flight to quality because we're witnessing kind of extreme scenario. There might be a flight to quality that the short-term bond can have a positive effect. But now you have 18% loss and it's a sea of red, right? And this is a moderate portfolio, right? You may not have this exact type of allocation, but I mean, you probably don't, but you have something similar. And what I'm saying is I haven't seen these types of conditions. So first of all, normally when equities are down, you have, if you shock only equities like we had in the beginning, there are much more green and the green bars are sort of bigger. But also what we're introducing is what Jan showed in the charts is the equities and global bonds dropping at the same time. And this essentially means there's no place to hide. Now, I'm not saying there's no place to hide and it's all over now. We're going to have in the next show, we're going to discuss some possible strategies to mitigate this risk because we don't want to make the shows too long. But really what I take away from all this going on, other than a lot of things are going crazy and now we need some government body to tell us what inflation is, as if we don't experience it. The real observation is that I love your charts, Jan, because they surprised me. Not a whole lot of things surprised me. But those were shocking to me. When I looked at the Japanese stock index, that's very surprising to me.
Yeah.
But the global bond, the degree, right? And I knew this was happening, but the degree to which the correlations are converging, I think it's pretty unprecedented. So I would encourage all of you to think about that. And this is not like, I'm going to do this over a weekend or on a Friday. No. This is something you should be focused on for months to come and analyzing and trying to understand where your risk bets are, how are you going to react to this? Can you make any changes? Because again, you can't go all cash because cash in inflation is not a great strategy either. You can't go all short-term bonds. That's just not your mandate. You have retirees. You have to do something that's productive for them, prepare them for retirement. But what we are saying is that the old ways of managing risk are not going to work. And if you're using like a simple risk number, right, a simple model like that, you're going to be possibly very surprised. I mean, we don't know what's going to happen, but this is a time to look more in depth at your allocations and risk.
What I would say is that even if that doesn't break, we think about VAR. I mean, basically that's all a number is it's the VAR calculation, right? If you think about that, let's say that you see that your portfolio, let's see that you have a chance of being down 18%. Well, great. What do you do about it? I mean, and that's what I really like about what our software does is that you can start to think about how do you get to that 18%, not just a general statement of, your portfolio can be down 18%. So let's just say it never breaks, but you want to know why, and you want to know what you can do to either change that, mitigate it, or be accepting of those assets that are going to be most likely to get you there. I mean, everybody knows that if you have a 60-40 portfolio, your equity is your most volatile piece, right? I mean, if you have a 60%, just a really simple portfolio, equity, fixed income. Equity is typically the most volatile. That's most of your risk. But where do you put it if you know that, or if you feel that the market is going to drop in the next year? Where do you put that equity allocation? Because, like we pointed out, that diversification isn't working like it used to in terms of negative correlation on your bond indexes. That's now 0 to positive depending on the measure that we use, and it's not going to offer you that same protection that it did. So where do you go? You saw gold increasing in correlation as well. It's not the same. I mean, it kind of went right lockstep with global bond, which I don't think is that surprising, but it's another one that just isn't the same.
It's not surprising because it's been so financialized. I mean, in many ways, when I looked at the gold trading, you don't know if it's real gold being traded. I mean, you look at these sell orders that come in. I'm going to sell you a train load of gold. Well, do you have it? Well, somewhere in the vault, there's a gold that has my name on it. Well, that gold has 20 different names on it. So we're printing gold like paper now. So it's I think physical metals are, not that it's a focus of our show, they're going to decouple from, and I think they're doing that to some degree. But in the next show, I think it'd be interesting, Jan, to look at the data and see where can we hide, right? And it's not cash and it's not low risk assets, because those are not necessarily going to do well. Are there risky assets that can provide some diversification? I think you as a advisor, or you're watching the show, make a comment. We'd love to hear your opinion. We really are going to focus more on comments. If there are enough people commenting, we're going to do live streams, Q&A. Tell us what you think, right? What are the assets that you think will do well? What are you doing? Because it's all about a discussion, and we want to be prepared. The more advisors prepare for this, the better off the whole industry will be.
Yep, exactly. All right, Daniel. Well, I think this could be our longest show, but hopefully people enjoyed it, and I think that hopefully they got something out of it. I'm surprising you with the graphs. I imagine that some of the people watching are not expecting those things either. So hopefully you got something out of the show, and thank you so much for watching.
It's definitely packed. Thank you so much. We'll see you next week. Bye.
Bye-bye.